Bloomberg Audio Studios. Podcasts, radio, news.
Now I want to take you over to the Economic Club of Washington, where I'm pleased to say that David Rubenstein, the Carlyle co-founder and host of peer-to-peer conversations on Bloomberg TV, is joined by a good friend of this program, the Bank of America CEO Brian Moynihan. Let's take a listen.
There's a lot of burden upon the banking system to both report suspicious activity reports and do a lot of analysis, and we have to close accounts. We can't tell people why we did it, and often we're told by authorities to close accounts. That creates confusion. Another area that comes up in this discussion is in the crypto area, where the regulator said you can't bank crypto operating companies, employees of crypto companies, et cetera. We are allowed to do, we bank everybody, but the operating company, they said that's a high-risk activity. Ask us for authority, and guess what? You would have never gotten the authority. So that came up as an issue. So at the end of the day, it's about getting these regulations right, and I think it opens a dialogue about how to get these regulations correct. In the end of the day, we're open for everybody. We serve millions and millions of Americans, trillions of transactions a year, and we'll continue to do so.
Okay, so when this administration was elected, there was a lot of, I would say, jubilation in the streets of the banking world. People thought that the banking regulation had been too tough under President Biden. Some people thought that regulation would be more amenable to banks. Has that turned out to be the case yet, or is it still too early to know? And is the banking community happy with the direction that the current administration is going, or you just don't know yet?
Well, so you have to sort of step back and say, the regulation of banking has always been true since our charter, our oldest part of a bank was from 1784. So we've been regulated from that day forward. If you think about the great financial crisis and Dodd-Frank and a lot of capital rules and liquidity rules and all that stuff came in, there was a reason for the world writ large to be really not happy with banks, and non-banks that became banks, Goldman Sachs, Morgan Stanley, Merrill, et cetera. So you could understand that. When you go fast forward through the 15 years hence, plus you go through the pandemic and the banking system stands up and stabilizes the economy. You go through the regional banking crisis, the banking system steps up and stabilizes it, and they keep adding capital and liquidity. You're sort of saying, wait a second. We are a source of strength. And by the way, the American banking industry is really a source of strength. So the pendulum kept just swinging, even though the reason why it had swung had stopped. And so our industry was saying, wait a second, why are we have 20% more capital than we did during the pandemic? The risk is the same. It's just by mathematical creep of calculations. Why are you saying we're going to limit your fees charged for a certain activity or deem an activity a loan when it wasn't a loan? With hundreds of years of history saying an overdraft is not a loan, somebody just says, I want to make it a loan. And so this idea of the regulators sort of imposing new rules and regulations that Congress did not intend, actually, was kind of an interesting question.
Right. So many people, when they talk about the Federal Reserve, they wonder whether the Fed's going to increase interest rates or decrease interest rates. But in the banking community, you're often worried about the stress tests.
Right. And
do you think the Fed has push stress tests to too tough a limit on banks, or are you okay with the current stress tests?
So the stress tests are publicly available. I think the first one was 2010 and then picked up in earnest 11 or 12. And so every year you can see this report card on the banking industry's health, and every year the banking industry has great health. But the issue we got in the banking industry ended up suing the Fed was behind the scenes that the rules kept changing in the tests. So if you think over the last 4 or 5 years, you had volatility in capital requirements that were, went from 50 to 75 basis points up and down a year with basically a test that said 10% unemployment, 50% downturn in the equity markets, 30% drop in housing, 30 or 40% drop in commercial real estate, high yield spreads blown out by 1,000, 2,000 basis points, whatever it was. You look at all it, the same test produces different results. It didn't make sense. So behind the scenes, the transparency wasn't there, and that's what we ended up suing them on. So the stress tests are a very good thing. Frankly, it gives us state of health for 31 banks, which cover most of the industry. The way the United States run them is far superior. We do stress tests every quarter, multiple scenarios, and our trading book is stressed every day. So if you think about it, it's a good thing. It's just that behind the scenes, what was happening is that dials were being turned on us, and the numbers were becoming irrational to the market, and we have investors, and we have to raise capital and have capital available for the industry.
So there's a vice chairman of the Federal Reserve who's in charge of regulating the banks and so forth. That person has given up that position recently. And was that something the banking community was happy with, that he stepped aside, or you didn't really care whether he stepped aside or not?
Well, at the end of the day, I think he had a year left on his term, and the new administration president would appoint someone for that position. Look, at the end of the day, as when people always ask me, do you have different approaches for different administrations? And you say, well, in the long term, we've been around since Washington was president. So if we geared ourselves up for this president, not that president, we'd have to change 45 times or whatever it is. And if you think even in the foreign soil, think how many different prime ministers there's been in England, or so even in my tenure as CEO. So at the end of the day, you run the company the right way. And what we're trying to say is get us to a rational regulatory structure and have it stick to the ribs. If you keep swinging like this, our clients can't depend on us when they need us.
So before the Great Recession, there were a number of large banks in the United States and Europe and Asia. And now it seems as if post the Great Recession and post-COVID, the United States is dominating the global banking world. What happened to the European banks? They're not really competing with you and JP Morgan and Wells Fargo as much as they used to. What happened? What are the American banks doing that enabled them to become so dominant in the banking world?
The American banking system is probably a story as much of American capitalism being successful, because in the days, the banks in the country represent the size, scale, and scope, and the vibrancy of that economy. So what happened from pre-financial crisis to now is, at that time, you and I would have been sitting here talking about how China's economy was going to be bigger than the United States by now. The European economy was as big and was going to outgrow the United States under the enthusiasm of the EU framework. And guess what? We're 1.5 times the size of the economy back then. Europe's like 1.1 or whatever it is. So we've outgrown them. That's part of the vibrancy and, frankly, dealing with the financial crisis, recapitalizing industries, failing a bunch of industry participants, bringing people into the tent, the right regulations, and then going forward. And so what's happened is Europe is not kind of crawled out economically. Therefore, their banking system has been hamstrung at the same time.
Now, you've been the CEO for 15 years, and the bank has recovered from a lot of problems it had when you took over. You've got a great career. Suppose the President of the United States said next year, I need a new chairman of the Federal Reserve Board, and you've been running Bank of America. Why don't you come in and be chairman of the Federal Reserve Board? Your response would be?
I think I'd say talk to David Rubenstein.
No, I don't think so. I'm sorry. So
our company, look, in the end of the day, I get up every morning, and I've got teammates out here in the audience, and this team is unbelievable. And if you see what we do for a customer, and my email's in the public domain, and customers send me when we're doing great things for them, and when we're not doing great things for them, come directly to me. Nobody reads them but me. And so if you see what we can do for a company, for individual, you see the enthusiasm for a young kid who's opened an account, enthusiasm for the 4,000 or 5,000 kids we hire between 18 and 22 that come into our company every year, the communities that we support, that just is a great job, and I love doing it as long as I'm healthy, as long as I have the energy, and as long as the team and the board support me, I'm good.
So recently, another banker you probably heard of, Jamie Dimon, and he testified on Capitol Hill that maybe the regulators and Congress should get together and say, let's just start afresh and take a look at all the banking regulations from a fresh perspective, building from scratch. Do you have a comment on that? Is that a good idea? Or?
Well, I think the spaghetti chart of overlap is the question. So you just take the Consumer Bureau. In 2010, with Dodd-Frank, 10 or 11, they set up the Consumer Bureau. The theory was that all the consumer regulatory activity would move to a new agency. Guess what? We still have the OCC regulates consumer activity, we still have the Fed regulates consumer activity, we still have the FTC will hit consumer activity on occasion, and you have the Consumer Bureau, and if you have the FDIC as a regulator, you have the FDIC. So none of that happens, so you end up with another added regulator. Much like after 9/11, HHS came in and it was supposed to swoop everything in, it didn't quite happen that way. So I think you could start with a fresh sheet of paper, recognizing that in the National Banking Act in the 1800s, or whether the Federal Reserve Act, the FDIC Act in the 30s, the world has changed a lot since then. And so, the idea of national regulatory consolidation, even on a dynamic country like the United States, is probably more appropriate today than it was when you had 10, 15,000 banks all distributed all over. And Tom Barkin's coming from the Richmond Fed. Tom is terrific. But there was a day when everything went on in Richmond, and the Richmond Fed catchment basin was only there. That day is way past.
You're regulated by the Federal Reserve, the FDIC, the Comptroller of the Currency, and anybody else?
The Consumer Bureau, the SEC, the CFTC. Then, put it this way, there's 100 plus regulators in our building every day.
So do you spend a lot of time with the regulators, or you try to avoid that?
I'd like to spend time when they're telling us we're doing good stuff. But no, we all spend a lot of time, and I have a great chief risk officer, and Jeff Greener, who organized that for the company. All my senior executives spend time with them. And look, the day-to-day regulators are trying to help us be better, and we understand that. We are on the road to perfection as a company. And as Vince Lombardi said, you strive for perfection, excellence to be found. That's what we're trying to do. If they've got ideas, we're all ears. Simplifying the organization will allow, frankly, cost to be taken out from the regulatory side, and we pay fees to support it. And it wouldn't be the worst idea.
Now, when interest rates go up, the theory is that banks can charge more for loans, and therefore they're more profitable. And banks have been very profitable in recent years. When interest rates go down, is that a concern to banks because you have less profitability, or you really don't care?
Well, the toughest time to be a bank with $1 trillion, $2 trillion deposits is when interest rates are zero, because we can't charge people to store their money. We're not like a self-storage unit or something like that. So at the end of the day, you have a floor on interest rates. And so when interest rates came down, you started squeezing margins. So the loan rates came down, but the deposit rates have a zero floor. When rates move up, that changes. And so the zero interest checking accounts, all that stuff become worth more, and the loan rates go up. So as long as the rate structure is more normal, and anybody that under the age of 40 has never seen a real rate structure except for like right now. And probably even a little older than that now. And so the idea of a 3% Fed fund rate isn't high rates, it's the usual rate, in fact, on the lower side. A 4.5% 10-year, the usual rate. And so in that environment, banks will make money. But at the end of the day, the net interest margin, which is the difference between what we lend at and what we pay for funds, tends to run 250 basis points. And that benefit goes back to the depositor side and to the debt holder side. And as rates go up and then ups and downs, it's just when it hits that floor, that margin got down to 150 or something like that.
As interest rates come down, though, it's not going to affect your profitability?
Not a lot, because you have...
All right. So you don't want Jay Powell's job, it sounds like, but suppose he called you and said, should I increase interest rates, decrease interest rates, or hold them the same? What would your advice be?
Our team right now is basically says there'll be no further rate cuts through their forecast period, which is this year and next year. And they were one of the first people to pull that off the table. And they did because they said inflation is coming down, but it's a bigger fight. And in the end of the day, there's the dual mandate, employment, inflation. Employment, they're in great shape on. Inflation, it's been coming down, it's working its way down. It takes multiple years to squeeze inflation out. They started in 20. And so think of 26 is actually a normal period to squeeze it out. And there's a drag on the economy today. And so you're seeing economic growth from 3% in the last couple of quarters to 2%. We have it moving down to 2%. So he shouldn't, our expectation is they won't cut rates. I think we have
for the whole rest of the year.
Yeah, for the rest of the year and the next year, and frankly, until inflation gets down.
And okay, so let me ask you: the business that my firm has been in is private equity, but now private equity firms have become private credit firms as well. And private credit firms, they lend money, but they're not regulated quite the way you are.
Right.
So is that a source of concern that we can lend money and we're not as highly regulated as you are, and you're lending money but you're highly regulated, or you don't care about that?
I think I care about your firm, but look, at the end of the day, the private capital has grown because they can do something we can't along a couple dimensions. One is they can finance companies that may have more leverage. And we are basically stopped out at 6 times leverage. And that used to be a rule, then it was taken back, then it was a guidance, and then it was like, wait till we examine you. And we do go above it for certain credits and stuff like that. So that's one thing. The second thing is the ability to bring the whole capital structure, debt, equity, the whole, mezzanine, the whole 9 yards. That's hard for a bank because we don't engage in the equity business. But on top of that, we have $1 trillion of commercial loan commitments, $500 million plus of drawn loans. We don't fear any competitor, and we work with those companies, including yours, to generate assets for them. But it's just a different style. I think the world should be concerned to make sure that those enterprises making loans to billion-dollar operating company have the ability to work with them in times of stress. That's going to be an interesting question. We haven't gone through a stress period with this practice out there.
I think J.P. Morgan, maybe other banks, maybe you have gone out and raised private credit funds that you can then lend out without the normal constraints that you have through the money you have from depositors. Is that something you've done, or you think it's a good idea?
We've created some capacity. In the end of the day, the credit we're willing to do is important as much as we can. So we have, we're dying for more loans. We have $2 trillion of deposits and $1 trillion of loans. We're trying to do all the loans we think have good credit quality, and so we don't feel this constraint.
Right, so let's talk about your background. I am an only child.
Yeah.
You have how many siblings?
7.
7. So, growing up with 8 people in a family, wasn't that crowded at times, or?
I'm trying to think. I didn't have. I was set up to get my own bedroom for the first time in my life, and my younger brother decided he wanted to move in the bedroom because he was scared to sleep alone. So I think, I'm trying to think, probably when I was in college, it was the first time I ever had a bedroom to myself. So yes, it was crowded.
So what did your father do to support 8 children? Was he in private equity or something important like that?
He was a research chemist for DuPont, and so he spent his whole life on plastics. So the graduate, plastics young man, my dad was that. That's what he did.
You grew up in Ohio.
Yeah.
And then you went to college in the East Coast.
Yeah.
And at Brown.
Yes.
And you were the co-captain of the rugby team.
Yes.
And do you still play rugby or not so much?
No, I don't play. I played rugby at Brown, I played rugby at law school, and I played rugby after. It's a great sport. Having never played it until I played it at college, it is, in a way, the most intense. What looks like disorganization out there is extremely organized, but it's unique in that it's physical and tackling. You kick, you run, everybody gets to handle the ball, and you run for 80 minutes. And so it's a very demanding game, and so it was a lot of fun.
Okay, so now you are the chancellor of Brown University, which means the chairman of the board, essentially. Yeah. So how do you have time for that?
Well, I've been on the board for 15 years, and at the end of the day, the chair of a board, Chris Paxson, runs the university, does a spectacular job, and our job is to govern and not.
So after you graduated from Brown, you went to law school at Notre Dame?
Yes, sir.
And okay. And did you play rugby at Notre Dame?
I did.
Okay.
Yeah.
So then you went to practice law back in Rhode Island, is that right? Why did you move back to Rhode Island? You're from Ohio. You went to Notre Dame and the Midwest. Why did you go back to Rhode Island?
Well, none of the Boston law firms would hire a person from Notre Dame Law School, so I had
Oh, okay.
It's hard to believe, but literally, I was the first lawyer hired by the firm over Rhode Island from Notre Dame. And they did it more because I had the Brown, connection stuff. But the big law firms in Boston, just even with one of my teammates working there, a fellow named John LeClaire, they couldn't convince him to hire me. So I ended up in a great law firm and had a great short legal career there.
Right. So I'm a big fan of people who are lawyers getting out of law and going into finance. So
I can empathize with you. Dave.
Okay. So you're practicing law. You're minding your own business. I assume you're a good lawyer. What kind of were you a corporate lawyer, litigator?
This is an interesting thing, Dave. When I came out of law school, when I went to law school, I was going to be a criminal lawyer because it was F. Lee Bailey was the talk of the world at that point, or I was going to be a labor lawyer. And then I went to law school and I went to a firm and oddly enough, I went to law school from 81 to 84. There were no corporate lawyers in America because it was before the 80s took off. And after the 70s, the activity died. So being a person that is impatient in life, I said, why don't I be a corporate lawyer? To much to the chagrin of the litigation lawyers and stuff who thought that I'd lost my gourd. But so I became a corporate lawyer more by, I could see the opportunity to get responsibility, and I did that for 9 years and became a partner.
So how did you escape from being a corporate lawyer? What did you do?
There was a fellow named, one of my mentors is named Terry Murray, who ran Fleet. And I did corporate law, a lot of work I did for Fleet. And then Terry, after we did a transaction called the Bank of New England transaction with KKR, put money into the bank industry, and we bought the Bank of New England, meaning Fleet bought the Bank of New England from the federal government in the early 90s after the real estate crisis. I'd structured that deal in a way that I'd structured private equity deals for our bank private equity firm, which was a thing called dual convertible preferred stock. It convert into parent company stock or bank stock. Never been done in a public array. Terry said to the general counsel, he's too smart to be a lawyer, which I never figured out what the general counsel thought about, who was a brilliant guy. And he said, get him in here, and we'll figure out if he's going to do something. So
I went to work at Fleet, which is headquartered in Rhode Island.
I just went to work for Fleet, and I was deputy general counsel for like 3 months, and then went on a special project to re-engineer the company and became the head of strategy.
And then Fleet ultimately merged with Bank Boston. And how did you survive that?
Well, that was the last deal I did. I was the head of M&A and strategy, and Terry Murray and Chad Gifford put together that deal, and Chad took a liking to me. I was an acquired.
Chad Gifford, who was the head of Bank Boston.
I was acquired taste for Chad because I was in the middle of negotiating, getting all the cost structure and getting the alignment, and I was meant to be the pain in the butt. And so Chad ultimately took a liking to me as a great mentor and said, you got to run a business, and put me in running a business. And we were merging two companies together, and I survived and ran the wealth management business for a few years.
You ran the wealth management business for the combined Bank Boston Fleet.
Yep.
And then Bank Boston Fleet combined company was sold to Bank of America.
In 2003 fall, yeah.
And so how did you survive that one?
Well, they asked me to run the wealth management business, the combined companies, and I did that. And Ken Lewis wanted to integrate some of the people, because the companies were maybe 60-40, but they're very sizable companies, and so he was trying to get a management team that represented both companies, and so Chad was chair, and Ken was CEO, and I went and ran the wealth management business of the combined company.
All right, but then you became the general counsel.
For 40 days.
For how long?
40 days and 40 nights.
All right, so you became the general counsel of the combined Bank of America.
Yeah.
And then?
Well, so what happened was, in December of 2008, remember we bought Merrill on the Lehman weekend and everything, so we were originally trying to buy Lehman. We said we couldn't do it as a company. I was running at that point the corporate investment bank and other parts of Bank of America. We couldn't do that. And then over the weekend, that's when the world became very ugly. And so we bought Merrill, and remember Morgan Stanley got investment from the Japanese bank, and investments were made around. And so after that, I'm sort of running the integration, a bunch of stuff as we're going through from October or whatever it was till the fall. And then around the time Merrill showed up with a $7 billion loss in the quarter, and with a lot less capital than we're supposed to have, we started telling the government we couldn't do the deal and stuff. And so Ken asked me to be general counsel because we were eliminating a lot of jobs, and I actually eliminated my job. And I was basically out of the company. He said, you know what, stay and become general counsel because we need somebody. And from December 9th to
all right, so you became the general counsel of the combined Bank of America.
As we negotiated with the government to figure out how to get the Merrill deal done, and then I went back in business right after.
But then you left after that for a while.
No, I became, so then in mid-January of 2009, I took over a bunch of the businesses after John Thain left and went back into business, and then by the end of 2009, I'm CEO. I had a lot of jobs in a short period of time.
All right, so now...
It wasn't what somebody should do.
Now, you bought Merrill Lynch at a discount, I guess, or low price, but it turned out to be a pretty good deal, I guess, right?
From an operating base, it was always a good deal. The issue was that the hole in their capital cost us some dilution. So, and we worked through that over time. So, with new capital rules and everything, we had about 7.5, 8 billion shares at the time. It went up to almost 12 billion. Now we're down to about 7.4. So we're back down to where we should have been. But it took a lot of work but from an operating base, it was always a home run.
Right, before your bank came back from a rough position, you borrowed, in effect, $5 billion from Warren Buffett. Is that right? More or less?
Yeah.
And it was pretty expensive capital, some people say. So did Warren Buffett get a better deal? Did the Bank of America get a better deal out of that?
Well, our stock was trading at $5. He converted at $7.14 a share. So it was a classic 20%. He had a 6% dividend. We were paying low dividend. But if you bought the common or the preferred had a 10% dividend that day. And the common, you would have done better because you would have picked up more the first $2. So you picked up. So
did you negotiate the deal with Warren Buffett, or is he pretty smart? Or?
It's apocryphal. He's told the story, so it's not my. But the idea came to him in the bathtub. He called up, got into the call center, believe it or not. Right. Then finally got someone to get a number, called me and said, I want to put $5 billion in your bank. And I said, we don't need the capital, Warren. He said, no, you don't. That's why I'm calling you. You need stability, and I can provide stability. And I said, yes, you can. The night before, a fellow named Mike Lyons, and now runs Fiserv, who was working for us at the time, and a fellow named Bruce Thompson and I were sitting there saying, we need to get some stability, because remember, what people think about is government shutdowns and defaults. The government was really in trouble in August of 2011. They couldn't come together in funding. They were starting to overdraft their accounts, let's just call it that. So that was going on, and then we were getting banged around because all the mortgage litigation. And so he came in, put the money in, and from then, from basically $5 share price up to $44, $45, whatever, it's been pretty unbroken since. So he's fared well, and we fared well.
Does he still have the stock, or has he sold most of it?
He sold about a third of it, and then he bought another 300 million shares. He ended up with 1 billion shares. He sold down to like 600 last I know. But he did very well, and we did very well, and he's been a great investor.
Let's talk about the beginning of Bank of America. So Bank of America started as Bank of Italy.
Yeah.
So who started Bank of America, and why did he name it after Italy as opposed to America?
Well, A.P. Giannini, who was Italian descent, started the Bank of Italy when he came to the country in San Francisco to help the Italian community that emigrated to San Francisco. And he became famous in the San Francisco earthquakes and fires in the early 1900s by setting up a barrel and starting to lend money. And then fast forward to 1999, when Nations Bank, which was the North Carolina Bank, which is the bank, the bank today, and the Bank of America merged, you had two good names. Nation Bank wasn't a bad bank name, but Bank of America was a better name. So they took the name, but the operating company that survived was Nations Bank.
So it moved from San Francisco headquarters to a Charlotte headquarters, where you are headquartered now.
Yeah. And it's interesting because with the LA fires, we've asked our teammate Raul and I to step in, because we have a heritage in California helping in times of stress, that we have a big business in California, and Raul's doing a great job. But you do have this historical ways that we've done business around the world. We're the first bank to make a loan in Japan after World War II ended at the request of the U.S. government to start lending money. We've been in UAE since it was formed. So you go back in heritage, it's just a wonderful heritage. And the Bank of Italy heritage is apocryphal because of Giannini. But the reality is the bank that survived all this and drove all this was the North Carolina Bank, which formed to bring capital to the Southeast as it grew because the New York bankers wouldn't come down and do as much business. That is the bank that survived all this. And so all these rivers came together and formed this huge river.
One of your predecessors as the head of Bank of America became the head of the World Bank at one point. You have any interest in being the head of the World Bank?
No. You've got Ajay coming in. I'll let him run that because I haven't been asked, and he does a great job. He'll be terrific for it.
So let me ask you about this. Banking today, why do we need all these bank facilities, bank
branches,
buildings,
financial centers?
Because everything is done online, it seems. Do you actually have a lot of buildings? Do you really need all those buildings you have where you have your bank?
This is the classic do as I do, not as I say. Because at the end of the day, between this morning when the banks open up to tomorrow morning, 400,000 people come into our branches. So this idea that nobody goes to a bank branch just is not true. The idea that nobody uses cash, well, about $250 million will go out of our ATM machines in the next 24 hours. The idea that nobody writes checks, There were 100 million checks.
How many banks do you have around the country now?
We have 3,700. We went from 6,000 down to 3,730.
And what about ATMs? You have a lot of them?
We have about 14,000 of them. At the high point, we had 18,000. And that's technology. At the end of the day, the huge technology impact in banking over a long period of time, but since the team started in 2010 coming together, really started a few years before that, we have been basically engineering the headcount, the facilities. We had 120 million square feet of real estate in 2010. We have about 70 million today.
Hey, now, have you ever gone to get money out of an ATM and been denied?
Not since college during the Great Blizzard of '78, when we were at the wrong. A friend gave us an ATM card to go out and get some money to buy liquor before everything shut down, and we went to the wrong bank.
What about
give us some money?
What about credit cards? You ever had your credit card denied?
Not that I'm aware of, but
okay. So
hopefully nobody else has that shouldn't have been either.
How has the world of technology affected the banking world? So right now, so-called fintech.
Yeah.
Has fintech dramatically changed the way Bank of America operates?
So we invest about $4 billion in new code every year. Every weekend we'll have a couple million lines of code go in to amend our systems and change our systems or add new technology. That's not to run the systems. That's another $8 or $9 billion. That is just new activity. So the impacts have been unbelievable. But people it's still human beings and what they do and how they do it. So you have to be high touch and high tech. So in the mid-'90s, when I was the head of strategy for the company, I remember consultants coming and saying, 20 years there'll be no bank branches. Well, it's 30 years, and guess what? We still have 3,700. And the reality is people want it all the ways. So, but the impact of the phone, the iPhone in particular, was so different. And we were the first app available on the iPhone. And the reason why is we built our technology through someone's prescience in the company to be a web-based technology back when people didn't do that. It was really an app-based technology. So it could be made an app back. We don't think of these things today, but back then that was an unusual thing to have an app. Everybody went to the websites, et cetera. So that took off. And so from that start, you now have 40 million consumers who bank digitally with us all the time. Last year we had about 90+% of our interactions with consumers are digital. Right. And yet the critical importance of a person going into one of our stores and saying, I got to figure out how to save more money. Can you help me do a financial plan? My mother's sick. I've got a power of attorney. I need you to figure out how I can manage her affairs. My kid wants to go to college. I need to figure out how to borrow the money. All those things are critically important, so you have to be able to do both.
So people still writing checks the way they did 10, 20, 30 years ago? Is that a big business for you, check cashing?
Check cashing is not a business. It's a convenience for the customer. The checks written from like 2019 and now are probably down 30 or 40%. There's still a fair amount of them. What you've seen is the dollar volume written stays flat, right, but the number written comes down. And we track that literally every week, but we track all our spending every week, but we can see what's going on in the American consumer. But in the dynamic there is people are still paying their rent or the mortgage or something like that, car payment with it. What they've done with Zelle, which didn't exist a decade ago and now is the dominant force. Our clients send more money over Zelle than total Venmo is sent, to give you a sense. And so it's become the dominant way. That's replaced a lot of small dollar checks, but the big dollar checks still go through the system.
In the old days, when I used to write a check, the bank eventually would send me back the canceled check. What happened to those canceled checks? Where do you keep them all now?
They're all document destruction policies, but they're all image-based. So even if you went to a branch and deposit a check, it's image-based right then, the actual check's destroyed. Right. It's the idea of taking a check deposit ATM. So about 15% of the bank's checks are deposited at the physical ATM. A lot of small business activity. The other, let's call it 85%, about 50% of it goes through mobile, taking a picture of it, which is you imaging the check. The other 30% goes through the ATMs, which the ATM takes a picture of the check. The check disappears in all cases.
So if I want to go to use an ATM and I have a Bank of America ATM card, but I don't see any Bank of America ATMs, I go to some other bank ATM, I pay a fee. Is
Well,
that
you wouldn't, David, because you're...
What?
You wouldn't, but other people might.
I thought you had to pay a fee. I mean, is that a profit center for banks, those fees? Or?
No. At the end of the day, we get 55% of our revenue, our $100 billion of revenue last year, 55% came from interest, 45% came from fees. The dominant part of those fees are trading revenue and asset management fees and things like that. We have consumer fees, but they've come down dramatically because basically we said to the consumer is, you keep changing your behavior, we keep driving down the cost to serve, and we'll give that back by lower and lower fee structure. So we have a no-fee checking account. We have a $5 simple checking account that people know that you can't overdraft. We do our overdraft fees when we first started changing our policies 15 years ago were $5 billion a year, and now they're $120 million a year.
So do you think we will have in our collective lifetime no more currency, everything will be digital, or you think that's not likely?
Not in our lifetime.
What about a digital currency, which doesn't preclude other things, but a digital currency?
Well, I think the new administration wants to push, so you have to think about three parts of this dialogue. There's a blockchain question, there's the stable coin type of currency question, and then there's the Bitcoin and other types of things. It's pretty clear there's going to be a stable coin, which is going to be a fully dollar-backed, type of thing, which is no different than a money market fund with check access, is no different than a bank account, really. And so, if they make that legal, we'll go into that business. So you'll have a Bank of America coin and a U.S. dollar deposit, and we'll be able to move them back and forth because now it hasn't been legal for us to do it, but it's just then like another foreign currency.
Okay.
The question of what it's useful for is going to be interesting.
Right. So in the old days, 10, 20, 30 years ago, if you had a lot of coins, you put them in a jar or your desk, and eventually you could wrap them up and take them to the bank. Now, if you go to the bank, they don't want the coins.
Well,
what do you do with these coins now?
we're going to get rid of the pennies, so maybe the other day, if you roll them and bring them in, they'll count them up and stuff. But it's a tricky thing because it's just a lot of work for.
Okay. So now President Trump said we're not going to make the penny anymore.
We'll take all your coins. Don't worry.
Okay. The penny. What about the penny? We're not making the penny. Is that a problem?
I think the economics that they're talking about is it costs more to distribute them. Look, at the end of the day, when you think about the bills, the currency, whether it's coin or bills, and it's mostly bills in terms of value. It's an interesting thing. So 98% of all the bills that move around the world, we move on a day as a service to the government. Right. And there's nothing bigger than 100. So $1 billion of hundreds weighs a few tons. $1 million of hundreds is a 25-foot stack. So there's a big physical part of this. Now, the reality is that's done for reserve currency and central banks. That's who holds it. The rest of the money all moves digitally today. So we'll move $3 trillion today digitally. So the idea in our consumers' money movement is dominated digitally, whether it's a Zelle payment, a wire, an ACH. At the end of the day, that doesn't include credit and debit cards, which would take another big part because at the end of the day, what's a debit card? It's just an introduction to digital. So getting rid of pennies and stuff, there's economic support. But the reality is we'll always have currency because that represents...
And what's the most common currency? Is it a $100 bill or the $1 bill?
I don't know that, but I'm sure there's more ones than hundreds. But at the end of the day, all the big, the real money movement to the central banks is all the hundreds. It's palleted hundreds. It's a wild scene to watch, pallets go through this. We go to the Federal Reserve, we pick up these pallets of cash and send them around to the central bank of, France to have their reserves.
Well, when you need cash, do you go to the bank and get cash at the end of the week, or do you just go to the ATM, or you don't use cash so much?
I do everything every one of our clients does. Look, at the end of the day, I often go and say hi to the teammates because that's kind of fun. So I try. If the bank's open, I'll go and say hello and get some money out. But at the end of the day, like you, like me, like everybody, you become. If you look at the way the money. So year to date, about 7% more money got moved by Bank of America consumers over last year, so that's pretty healthy. If you look, 25% went by credit card payments, and about 14% went by checks and Zelle and other stuff. Cash was probably in high single digits. So it's not a lot of cash goes out of the ATMs every day when you put it against these other payments. So $4.5 trillion will go out in cash. How the ATM today is a couple $100 million, and that's going on an economy being spent. So the healthy consumer spends money, and that's good, but they use all the devices. Cash is becoming less, but it's still critically important. And so that's why you have ATMs, and that's why you have branches, and that's small businesses receive cash especially and bring it in deposit, and that's why you need a physical plan.
So if I go to your bank and I want to make a deposit of $10,000 in cash, I'm going to get reported to the federal government.
Yes.
And 10,000 isn't what it used to be.
So one of the reforms we're saying is, and somebody testified a few weeks ago to this fact, so I'm paraphrasing their story, is they said when 1972 they set the $10,000 level. The theory even goes back to the 40s, but let's just say 1972. And in 1972 you could buy a fully loaded Cadillac for $10,000. We're now this many years later, and we still report not only if you did 10,000, but if you did 3 or 4 transactions in a period of time that looked like you were trying to evade the 10,000, we'd have to report that too. One of the simple answers we're saying, just index that to where it should be, which would be like 100,000. When you do that, that takes out all this activity and moves it away. And $100,000 is the inflation-adjusted amount from 50 years ago for 10, or maybe 78 or 80,000. And so if you're saying lift that amount, you'll take the average transactor completely off the table, and you really will be looking for people who are trying to move significant amounts of money or avoid the transaction level. It's such a simple fix, and I think people can see that. And by the way, in 20 or 22, there was an act passed that became law that gave the authority to Treasury to do that. They just need to do it now.
Right. So now you live in the Boston area, as you have for many, many years. The main, biggest headquarters office I think you have, or financial center office, is in New York, and your headquarters is in? Charlotte.
Yeah.
So is that inconvenient for you to go all these different places?
No, it's not, because we also travel all over. It's like, I'm here today, I'll be in Florida for a couple of days, and et cetera. So we move all over as executives in big companies, and you do too. But the idea of moving people around and moving their, where they work and moving their families, it's more difficult than 20 years ago when we said we're moving the headquarters to Boston 30 years ago. You just got to move. Right. There was not a question that you said, oh, maybe I got a better idea. So as we look across that, we have 16,000 plus people in Charlotte. We have about the same amount when you take New York and the areas around New York. But we also have 5,000 people in Boston. Around there we have 40,000 people in the state of California. We have 30,000 people in Texas. So Florida, we have operation centers in Jacksonville. So you have people everywhere. And the idea is we try to always look at it and level load, activity around the country to avoid, to use time zone differences to our advantage for call centers and to access talent pools. And then remember, all our branches and our private banking teammates, our Merrill teammates, and our business lending teammates across all the businesses, they're all in the field. They're in 9,700 markets out there every day.
So if I wanted to make an investment in a bank stock, would you say it's a good idea to invest in bank stocks now, or do you think bank stocks may be overvalued, or what do you think?
Our valuation difference to the S&P is lower than it's been, and I think our company is a great value, and the rest of the banks are pretty good value.
Okay, so now, when you took over the bank, you had more employees than you have today. The bank has expanded. Why do you have fewer employees? Because your bank's so much bigger. So
that's technology, and that's applied technology. So in 2010, we opened with 284,000 employees. We went up to 305,000 to peak, and we ran as low as 204,000. Now we're about 213,000. And so all that was done with applied technology and digitization, new technologies, both. So if you think about work, the way to get rid of work is to eliminate and re-engineer the work and eliminate steps and things like that. You can do that through automation. You can do that through just not doing them, et cetera. Avoid duplication. Then you can eliminate management of work, because if you have less people, you need less managers. And then you eliminate the real estate that people sit in. And so we've been doing that on and on again. But the key to make it really move was technology. And so whereas we had in 2010, we would have had 5,500 branches. We now have 3,700 branches. We actually have probably almost 1,000 of those in places we did not have branches back then in different cities. And so if you think about maybe 600 or 700 like that, so you think about that, those branches are bigger and more efficient, but all the transactions that come out, right, and what's in there is sales activity and relationship activity. And so it's just that constant re-engineering. We have this thing called OpEx. Every year we come up with thousands of ideas to take out and re-engineer the company. And so at the end of the day, more customers, more activity, more people, and yet you've driven the headcount down, and our costs are 2/3 people. And then basically the other third is some advertising, the buildings, and some technology and electricity.
Now, there's an acronym today that some people in Washington don't like called DEI.
Yeah.
Do you have a DEI policy or not anymore?
We have diversity and inclusion in our company, but let's step back. What we've always been is a bank of opportunity. So we think about creating an opportunity for our teammates. And how do we do that? We go out and hire from all areas and bring people into our company. So we go to 400 different schools to recruit kids. We have a program we call Pathways. So Pathways we announced in 2018. We said we'd hire 10,000 people from low and moderate income neighborhoods to come work in our company. We completed the first 10,000. Then we went out and said we'll do another 10,000. We're up to 30,000 people over the last decade almost that we've hired from LMI communities to come work for our company, from high school, junior college, and colleges to come work. So once we have a very diverse company in terms of representation from all economic stratas, all races, all ethnicities, once they get in, the opportunity is there of a lifetime. We equal pay for equal work, the ability to promote, we train, we do all the work. And so the idea is that's an opportunity. When we look outside our company, we try to work with other employers to create the same opportunity we create. We try to work with nonprofits and communities to create opportunity for them to be successful. And so the idea is just create opportunity. So we have a diverse team. We stress inclusion. So when you're at our company, you can be who you want to be and be successful, including we have 300,000 memberships in our employee resource groups, of which about 60% of the people are in one. The average S&P 500 company has 5% of the employees. Our employees love to work together. They're open to all, even though a cohort. And so we just try to create opportunity.
So a young person who's graduating college, why should they go into the banking profession as opposed to private equity, investment banking, healthcare? What's the appeal of working in a bank?
Well, when we bring the 2,000 kids in and I talk to them, I always say the same thing. You can make a lot of money doing a lot of things. You can have a great career doing a lot of things. But if you're going to come to our company, you really want to help people. You want to provide the answer. Our market position is, what would you like the power to do? And I said, your job at this company is to help people answer that question, whether it's a customer, whether it's a teammate, whether it's a shareholder, whether it's a community. And you got to come and want to do that. You want to deliver a lot of profits done the right way with a purpose around it. And if that's what makes a place special, and our turnover rate's an all-time low, and we are sought after by young kids to work. So you hear everybody's going to tech companies and stuff. We have hundreds of thousands of applications for the 3,000 we hire.
Your Bank of America is mostly focused in America, I assume, but do you have a lot of business outside, and do you want more business outside of the United States?
Yeah, we do business in 130 countries. We're in 30, 40 core countries. We've been in, like I said, in Japan, for 80 years now, in India for 65 years, and Brazil since 1954, and Argentina since 1914. So we have an international business, and the amount of loans we have outside the United States for commercial customers exceeds what we have in the United States for large corporate customers. So we're a global business for global investors, global firms, private equity firms, global investors, global companies. And so we do investment banking, corporate banking, treasury, cash management, and trading across the world. And we're top 2 or 3 in the world in these businesses, going back to your earlier point, that the U.S. companies that come to dominate those businesses, and we're right at the top.
Were you ever at a cocktail party or a lunch and somebody gives you a resume? Does that ever happen to you, if somebody they think should be hired by the bank?
There's this thing called email that gets them there faster nowadays.
Okay. All right. And what now, on the personal side, you've been there 15 years. You haven't announced any time when you might step back, and you're not prepared to announce that today, right?
No, I don't.
Okay. So
I'll tell you first, though, David.
Okay. So have you been able to convince your children to go in the banking world?
My oldest son's an investment banker for a different firm, obviously, and my middle child is a risk manager for another firm in financial services, and my younger's in communications and stuff. I never said, look, being a CEO's child is not the easiest thing, being a CEO's spouse. So they saw me work in different ways across the years, and so it's their decision what their career is, and it's nice. My son, he's a deal doer. He's an M&A type of guy, so it's fun because I used to do that. I haven't done that in a long time.
What do you do for rest and relaxation in all your spare time?
I do what everybody else does.
You're not
and
a
that was
rugby
David
player
Rubenstein
anymore, right?
speaking with Bank of America Chief Executive Officer Brian Moynihan at the Economic Club of Washington. And you can watch more of that interview on the David Rubenstein Show, Peer-to-Peer Conversations, on March 12th at 9 p.m. in New York.